all this talk about bull put credit spreads, and I've had this debate of starting with Jesus's question, but I want to end with Jesus's question, and he's been very patient here. Jesus kind of has the most important question of everything we've been talking about. Jesus says, Mike, hello, can you go over the market sentiment? Are we still neutral? Yes, we are. And would you recommend bull put credit spreads? All right. I had an email I had to answer today that came in, and Ernie and I actually, this is one of those ones that came in, and I wanted to ask Ernie's thoughts. I do from time to time, don't get me wrong. But I wanted to make sure I got most of it right. I wanted Ernie's thoughts on this before I gave my straight answer. And the question was from a gentleman named Austin, who's a PowerOptions subscriber. And his question was very similar. His question was more pointed. And his question was, we haven't seen a sell warning, and the market sentiment has been neutral for all of September, yet we saw a significant decline. How come we didn't go into a bearish warning? The last bearish warning we had was back in July, this time period here, July 9th, 12th, 13th, and 14th. And usually what we expect to see when we see sell warnings in a row or a bearish sell comes up is sometimes within the next 10 to 13 days, you expect to see a decline off of the highs. And the highs at this time are around 4,400. And 2 to 3 weeks later here, we're in August, and we did see a drop down to the 43s. And then it stabilized. And then we went back up to new highs here. Now, this is where I want to focus on for a moment. I know it's not easy to see. I can't expand this too much. Let's see. Can I do that? Yeah. In any case, the most recent high was here at 9.2. Now, what am I seeing here as a pattern leading up to this? We had a sell warning, Jesus, back in July. And even at that time, even though we're at neutral, what are we still seeing? We're seeing an outnumbered bearish to bullish. Bearish to bullish. We're seeing 2 bears to 1 bull. And we still have more bears indicators than we have bulls, but the others are staying neutral. Which means what? Okay, we're still kind of in a neutral market, and we saw that. Now we're hitting a new high here around September 2nd, 55.22, 55.20, I'm sorry, 45.22, 45.24, 45.36. It was, no, it wasn't the 27th, was it? I think it was the 27th, or it was the 3rd. When we were on the webinar on Friday on the 3rd, I checked it after we started the webinar at 4:20 or 4:30. I think it's on record. I'm going to look at it up there because I was expecting that this was going to go to a bearish marker. Or it was, we were on the webinar here on 9.2, and it still went up. It stayed at 9.4535, excuse me. I expected this to go to 4 and to get our first sell warning. And I said that during the webinar, and it didn't. Something eased off here and went back to 2. I'll tell you which one it was. So we had put call volume ratio, stocks hitting their new 52-week highs, and the number of days above the SMA 100. The next day on September 3rd, I thought we'd get another trigger, and this would have gone to a sell warning. We lost the number of stocks hitting their 52-week high and low. That actually pulled back because some of the stocks declined, but it wasn't enough to trigger any other ones. There were some that were close to bearish, other than that one, wasn't it? The VIX was not too close. I thought there was another one. Oh, yeah, here it is. The MACD gap. That was close. I thought this was going to trigger, and potentially the SP gap over SMA 100 was going to trigger. It eased off a little bit and settled a little bit lower, so it went back to neutral. But let me go back to today. I'm sorry. Let me go back to current and go back. So on that day, that jumped to a 3. And that was close. And again, I thought we were at a peak, and I thought it was going to go bearish, and it didn't. And it sort of pulled back, and it's sort of falling. But what are we seeing a trend here? It popped back up here when it went back up to 45.20 and 45.15. It's getting close. 4 is the signal when it will go to a sell warning, and it didn't quite make it. But what are we doing here? From September 8/27 at 45.09 through this time frame here, we drop a little bit. We go down to 44.58 here, a little bit of pullback, 44.43, and then we come right back up. I'm sorry, we came right back up to the 45s here on the 8th and 9th. There's our trigger, and there's another trigger there. It went to the 3rd. I'm sorry, that's what it was. I'm sorry. 9.2 is when I thought, and 9.3 I thought on the webinar it was going to go to 4. It didn't. And then it sort of eased off, but things went back to a 3, didn't quite reach a 4, Jesus. And now, 9.10, we're starting to see this. We're starting to see this. The market's pulling back. There's hesitation, but it's bouncing around this 44.80, 44.30, 44.60. By definition, a neutral market. That's in the noise right now. And then September 20th hits. Okay? This is one of those black swan events that we get concerned about. This is one of those ones that sometimes cannot be picked up by the market sentiment tool. It can't pick up external global forces and external jitters that cause the market to drop. The market sentiment is picking up reactions to what the market does and what happens to the market instance. Okay? And so what happened in this case? Well, this was the Evergrande. Monday morning, we woke up and the Chinese market's taking a hit. The Asian markets are taking a huge hit overnight. We see a big hit in the morning. Why? Because fears of this Evergrande holding, which some people related to more of a Bear Stearns back in the 2007, our Bear Stearns, this Evergrande big mortgage holding company is defaulting, as we all know. We don't need to go through all that, but it's going to default on its $300 billion loans, I believe it was. They had owed $83.5 million in the next 2 days, and everyone was pretty sure they just weren't going to pay it. And I don't think they did, as a matter of fact, and I haven't looked it up since then. But that's what caused the panic. And then what happened? We went to more bullish indicators than bearish. And we go back to here where we're seeing more bullish indicators than bearish, and we're moving. Yeah, we went down. We went down a lot. Went down to 43.57, 43.54. 3 days later, we're right back to where we were on that Friday, on the 24th. We were exactly right back. There was a panic. There was 2 days of fear. I even had to do a webinar on it to kind of soothe people's nerves. And then we just started moving back up and back up. And then the 28th, some more bad news comes out. This was related more to the debt ceiling, Congress fighting over that. There were some other things and bad earnings that came out on the 28th that caused that. And we get another drop in this case. But what are we doing? We're waffling back and forth between 2-to-1 bearish to bullish, 2-to-2 bearish to bullish, 3-to-1 bullish to bearish, 2-to-1 bullish to bearish, and moving back up. Slowly, yes, but we're still in the range of where we were. Now, I know, we just look at SPX, over the course of September, and we're seeing a significant decline. And the last warning we had was in July. I'm trying to narrow it down. There we go. There we go. Okay, that's close enough. So yeah, we're down significantly from the height at 45.40, 45.20 when we almost hit the bearish sell warning, but it didn't quite trigger. And it eased off, but it's still at 45.20. And we have this little dip down here. We're in the 44.60s. We recover up a little bit, and then it did lean down, and then the big push here, that ending here on 9.20 was because why? Well, from 9.17 when we were up here at 44.20 down to here was the Evergrande incident. Something that can't be picked up. No one could tell that was going to happen ahead of. No market indicator, the trend, the VIX, nothing knew that was going to happen. It just came out and then sent shot waves through the global markets, and that's the effect. And then, like I said, 3 days later, right back to where we were before, and then the last few days, 4 days, 5 days, we've had this other trend down. But looking at the way that I answered part of the email for Austin was looking at this changeover from even bullish to bearish to more bullish than bearish to slightly more bearish than bullish, then back to a little bit more bullish than bearish. What is that a definition of? That's a definition of a neutral market. Yes, we're down from where we were at the high, but that was the highest we've seen at the beginning of September, 4,540, isn't it? That's the highest we've seen. And so you knew it had to pull back off of that. And as I mentioned, I expected it to trigger. It just didn't. I was expecting that day during the webinar 9.3 that this would have triggered potentially up. I'm sorry, yeah, from 9.2 to 9.3 that this would have triggered up to the 4, and it didn't. It stayed at the 3. And yes, we're down. But if you look at the average price, and I believe I did this for Austin, the average price in September was right around here at about 44.40, taking every day's closing price, adding it up, and then dividing by 21 or 22, whatever it was. I don't think I included October 1st in it. But the average price was still 44.40. Yeah, we're still down 3% at this low here from what the average was, which means we're down much lower, 5.5%, 6% here from this point. But we came off the highest high, kind of settled, unexpected event, came right back, overreaction, and then other things came into play. Some were earnings, some was about the debt ceiling right now. So to answer your question, this is what I look at when I look at the market sentiment tool. I don't expect it always to give me a trigger for certain declines. And this I don't even consider a decline, by the way. This to me is in the noise. I was expecting it to trigger because we were hitting brand new highs and it was still going up. And maybe expecting it to trigger here around it was here around 9.8 as well, and it didn't. It eased off, and we can see why. But what we're seeing now is a trend where the bullish indicators, whose last signal was a light buy, the bullish indicators are still outweighing the bearish indicators, but we're also still in an earnings season. We also still have our government, the US government, fighting over the debt ceiling still. And yes, they funded the government through December, but they're still going through the other discussions, and that's causing some hesitation in the markets. And there's other forces there as well. But looking at this with more bullish indicators than bearish, still in a neutral market because it's trying to find its direction, isn't it, Jesus? It's waffling between some slightly more bearish than bullish and some slightly more bullish than bearish, and it's trying to get a grasp and get its direction. But that's still a definition of a neutral market, even though it's down. If we look at it, it's down 6% in the extreme, just looking at September, right? But we go further out. Okay, that's 3 months out. Let's just go 2 months out. I apologize. Let's go 2 months out, roughly. Yeah, I'm sorry. Going out to the beginning of July. We just look at the 2-month trend here. Yeah, and we're not too, it's still about the same. We're still about 3% off of that, but that's not too much. We're much worse over here. July 18th, we remember that. It did pretty bad here. So what is the crux? Am I saying that the market sentiment tool doesn't work because it won't pick up the external outcomes and black swan events? No, it's not designed to do that. Am I saying that you shouldn't be concerned about this 5-6% decline we've seen in September? No, what I'm saying is you shouldn't be too overly concerned because the highest high we've ever seen, right? And you have to come off of that at some point, and we did. And then there was an event that was unexpected, and then we're still dealing with some other things. And we're right back to where we were 2 months ago. That's a concern. Okay, are we at support and resistance? I mean, I'm sorry, are we at the support level now? Or are we there? Did we hit the bottom? I can't answer that. What I can see, and what I can tell you based on the market sentiment and what we've seen this month, is that it is waffling between bullish and bearish. It's trying to find direction. We are seeing more bullish indicators now than we are bearish. The last signal was a light buy signal. And yes, you look at the last 4 days and say, what the heck? Probably phrase that differently, Jesus. But again, this is trending towards a direction. I'm not saying we've hit a bottom, but this is trending towards a direction where, yes, I would still consider bull put credit spreads at this time with a caution. I might look for higher probability and lower volatility stocks in this case. Stephen might have think we've hit the bottom based on our discussion, the higher implied volatility bull put spreads. Fernando might think we've hit the bottom because he was looking for, we showed him a way to find spreads with a better risk reward ratio where you have to go closer to at the money. And he had mentioned it's maybe okay to go at the money with a lower probability. Not something I prefer, but if that's your sentiment, because you're expecting a bullish move, and I'm not saying that should be, I'm not saying it's mine. But what I am saying is that based on what I'm seeing right now, why the market indicator, market sentiment is still showing us neutral, I can see why just looking at the numbers on a day-to-day basis. We are seeing more bullish indicators, bearish based on how the market's been reacting. In this case, on Monday, I'm going to do the same thing I did on Monday the 6th, 5th. Market was closed at 7th. It was the 7th. During this webinar on the 3rd, I did mention, of course, that I was on schedule to open new bull puts. as I was, of course, if I was going to open them on the 7th, I was going to open them on the 20th. I did not open bull puts, and I had mentioned that during that new webinar we put out on the 21st or 22nd. Because of that movement and that action on Monday, I did not open new bull put credit spreads. I wanted to see where the market was going and if the market was going to settle. I did open them 7 days later for the expiration going forward to the 8th of October in that case. And if I have positions that I had closed out on my cycle of what I'd be doing, I might still, Jesus, be looking to open bull put spreads on October 1st. But I'm sorry, my apologies, on October 4th on Monday. However, something happens over the weekend and Monday morning news comes out and we're down 0.5%, 0.6%, or 1% because of digesting global financial news that happened over the weekend on our market open on Monday. I'm going to wait again, as I did back on the 20th, to see if the market can find a direction to find some legs before I feel confident entering new bull put credit spreads, even with the 80 or 85% probability. That might be going too close to giving direct trading advice, which I'm not supposed to do on these presentations, Jesus, and I'm not supposed to do in general. But I feel comfortable with the neutral indication and the neutral indicator, on the market sentiment tool based on what the market sentiment tool really does and what it evaluates. It cannot pick out an outside event, an outside force in that case. It can't pick that up. It doesn't know what's going to happen in the Chinese market. It's not reading those indicators. It's reading just what's happening in our market, and that historically we've shown when the indicators hit 4 bearish and no bullish, that's a sell warning. If it goes to 5, that's usually a bearish sell warning, means something imminent is likely to happen, as we've shown in the past that it does. And when I see a light bull or a strong buy, as we did, of course, on March 25th or 24th of 2020, that's when we started loading up into positions. And Jesus, your point you just mentioned is fantastic. And this is still something I do in my analysis with bull puts as well. He says maybe just not do bull puts only on stocks that I want to own. And in general, I will take that into account. We had talked earlier about looking at the position where for Salvatore, doing the 30 contracts and what is the monetary risk if you were signed early. And I talked about what I look for in that situation where I only want it to be a certain percentage of my portfolio. I don't want to go beyond that because of the monetary risk. Yes, there is the risk of early assignment and you have to pay attention to it. Usually I close them beforehand. But yes, Jesus, like you, when I run that bull put credit spread search, I do some analysis on the stocks themselves and make sure that if the worst case scenario happens to my portfolio, I do want to make sure that I'd be comfortable owning that stock for at least maybe a cycle or two to maybe help manage it if it's underwater with a stock repair, with selling covered calls, or another approach as well. And I know no one here on the webinars is going to go ahead and jump in and start doing bull put credit spreads on Monday if they've never traded them before, just because of our recent discussion with Jesus. But it is important to remind everyone that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. I'm not suggesting we open bull put credit spreads on Monday. I'm saying based on what I'm seeing in the market sentiment tool and how I read it, I'm still comfortable with the neutral reading, not seeing bearish, not seeing overly bullish, but the last signal was, in fact, a light buy. But again, I can't tell you what to do. And if you do decide to do some type of spread, I'd suggest the higher probabilities, 80, 85%. And as Jesus mentioned with the bull puts themselves, doing those on stocks that you would not mind owning if the worst case scenario happened. As we've seen and discussed in several discussions, say options do involve risk, and many strategies may not be suitable for all investors. Proper position sizing is key to being successful long-term with any strategy, leveraged, covered calls, naked puts. You always want to keep that in mind. Don't fall into the trap of the lie of leverage by over trading just because we can. Today, we looked at creating a bull put credit spread search to match Stephen's views. We went through the search also to look for implied volatilities and other instances as well. We showed how to use the profit and loss chart for different evaluations and how to adjust the search tool for the married puts, which applied to any strategy we would do. If you like the tools that you saw today, Remember, you can take your free trial at any time. Just need name and email address, no credit card required. You'll have full access to the site for 14 days. After the 14 days, the subscriptions start at just $45 per month for the lower end of day service subscription. Of course, you can cancel at any time. There is a delayed service, 15 to 20 minute delayed data at $65 per month, and a real-time service as well. All trial members and subscribers can have free coaching sessions at any time. That's a 35 to 45 minute phone conversation with myself or Ernie. You can also upgrade your subscription level at any time as well. And of course, you get full access to the webinar archive. Speaking of which, other free education we showed earlier for Pierre how to go to YouTube and just use that search function for short strangles to see other ideas. We also have the archived webinars page on Power Options. Just go to powerop.com/webinars.asp, or if you're logged in, just click on the free webinars tab. And some of the presentations, most recent presentations, may not be available for trial members, or only available for subscribers. But you can always go to the YouTube channel. All of our videos, we try to post most of them for public view on YouTube. And yeah, you can just use the search function there in the video section to find the topics that match your requirements. Now, if you think of any other questions later on after the webinar this weekend, remember, send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, trial members and subscribers can schedule a free coaching session at any time.